Meme stock mania is back in the market as retail investors pile into little love names like Krispy Kreme and GoPro. Meanwhile, the meme darlings of yesteryear, literally Opendoor and Kohl's yesterday, are falling. Joining me now in this ever-evolving story is Tom Sosnoff of Tasty Live, founder and CEO. Tom, it's good to see you here. I mean, this kind of thing keeps sort of rearing its head periodically, right? And a lot of it has to do not necessarily with fundamentals for these stocks, but maybe more for high short interest where traders see an opportunity to sort of push a squeeze through. What do you make of it? And does it tell us anything about bigger picture investor psychology right now?
Well, I think it's probably, it may speak to a couple of distant red flags, but I think for the most part, I don't actually like the argument that it's a short squeeze per se, because most of these stocks, especially when you're talking about like GoPro at a buck and something, and you're talking about Open, which was $1, $2 stock at the time. Most people aren't short, $1 and $2 stocks. I mean, that would be pretty rare to have a short squeeze, on a $1 stock. I mean, Kohl's might have been a little bit different, but when you start to think about, really cheap stocks, most people cover their shorts by that time. I think it's just there's a lot of speculative money sitting on the sidelines, and it's kind of like fun. It's more of a game.
Well, and one of the things that sort of speaks to that, maybe our head of news, Miles Udland, has this vibes-related theory about the meme stocks, is that there's sort of a millennial nostalgia quality to this, right? When you talk about a Kohl's or a GoPro, for example, that maybe is feeding into this a little bit.
I think that's some of it. And this morning, we were having a discussion on Tasty this morning about it. We were talking, and I was saying, you know what? This is also the time of year, I know it's going to sound crazy, but this is also the time of year where there's no real sports to bet on, because it's really just baseball. And we're kind of in between, all the other sports. Football season hasn't started yet. So, what better place to gamble than a zero commission, zero fees, in and out of all these little penny stocks for basically no money. I think it's just a lot of, again, it's a little bit of speculative fever, and it's not from a brokerage perspective, we like it not because of the volumes, because they don't really mean anything. There's no money in this. It's more of just getting people engaged. And if it brings young people into the marketplace, it's not necessarily a bad thing. I just think it's hard to make money.
Yeah, I mean, I guess maybe somebody is making money in this stuff, right? I mean, but it's also interesting to me because that, Tom, is a little bit of a shift as well. Like in the beginning of the meme stock boom, there was a lot of sort of hand-wringing, like, these people don't know what they're getting themselves into, and they could really lose their shirts. And I feel like we've sort of evolved from that, right? Like, I think everybody knows you could lose some money. Like, it is a possibility. Or do you? Do you think that that's not still well understood?
No, I think there was a couple of factors, like a perfect storm. If you're talking about like 2020 and you're talking about GameStop, and there was a bunch of factors, and there was a lot of professionals that got involved, on the short side of GameStop, from hedge funds to market makers. And that was a very different animal back then. Now it's a little bit different. This is very similar. I mean, this is almost pure retail. And this is very similar to, just kind of like a meme crypto coin or something like that. And it's kind of just like it's a pie in the sky. It's just a cheap shot, I think, the way people are looking at it. And I wouldn't read that much into it, except when this stuff happens, the markets are usually getting a little frothy. Like a lot of the big names are kind of off the table because they've had such incredible runs and they're so expensive.
Right. I mean, it's funny also that you're not seeing a GameStop or an AMC or whatever really as much participating in this current situation. If people are going to play this stuff, if they are going to, for lack of sports gambling, if they're going to do this kind of thing, I mean, what advice would you give them as an experienced investor? If they're going to do it, what's the best way to do it or the best approach to take?
Well, I'm an experienced player because I've been around the block for a couple of four decades. But when it comes to this kind of stuff, like penny stock stuff, I'm just like everybody else. I mean, I don't have any edge. My preference, I'm mostly a derivatives trader, so I trade mostly options and futures. But when it does come to penny stocks and stuff like that, and this kind of, meme stock stuff, I actually like trading the stock more than I like trading the options. I think the option markets on a relative basis are a little wide, just given how cheap the stock are, and there's a little less edge. I think these stocks are a better pure play, and like I said, they're transaction free at virtually every firm. So, and the bid ask spread's only like a penny wide. So I think if you're going to play the game and you want to take a small shot, you just want to throw something out there and see what happens. I would do it using the underlying stock.
Do you think that any of these companies are in a position to capitalize on this? I mean, I think that AMC is probably the best example of that. I, off the top of my head, can't think of any other companies that have really done a good job of that. Do you think, though, there's opportunity here?
I mean, I think that GameStop, when you look back, when history kind of talks about all this stuff, I think GameStop is the one that was able to kind of float some stock and raise some capital and change their model and all this kind of stuff. So I think GameStop got lucky. I think these other companies, it really doesn't have much impact. It's if any one of these companies like Kohl's or any one of these other companies were to try to go out and float either convertible debt right now or stock or anything like that on any kind of an uptick, they would just slam the stock. So I don't think it changes the company. It brings some of them back into play. I mean, it's great PR if you've never heard of Opendoor before, if you forgot what GoPro was or something like that. I mean, the PR part of just getting your name out there, that's not bad for these companies. But I don't really think that this is not a transformational or life-changing moment for any of them.
Right. Tom, fun to talk to you about this. Thanks for joining us.
Thanks for having me.
We're seeing activity in Beyond Meat, GameStop, but I've been tracking these moves in Opendoor, which are just totally wild. What do you tell folks that are in a stock like Opendoor, trading in and out of this frenzy of a company that, barely makes anything?
Well, first of all, I want to know why I'm the one to level set on meme stocks.
Well, you always have you focus on valuation. You're the long-term minded investor. Just bring clarity to these folks out there on the Yahoo Finance platform bidding up these stocks. I mean, this is wild stuff and really came out of the blue.
Yeah, and I was just kidding about that. But meme stocks, look, the phenomenon of meme stocks isn't going away. I feel like the genie's out of the bottle. And it's just become a way for a certain subset of everyday investors to trade. And that's completely fine. It's your money. You do whatever you want with it. If you're trading these meme stocks, if you have a little bit of cash on the side, I mean, what I'll say as a side note, what we've seen is that investors do still have a lot of cash on the sidelines. So does it surprise me that more speculative mania is creeping into markets? No, and I don't think you can say when the froth is too much or not. You can only call a bubble in hindsight, so I'm not going to do that. But if you are trading these meme stocks, if you were one of the investors in Opendoor yesterday during its wild ride, just remember to set your targets. Understand why you're investing in Opendoor, and really, again, going back to the targets, really understand where you're getting in and where you need to get out.
Callie, I was actually going to ask you if you were down with the full sugar Coke. I mean, that's what I had written down. But we're on live TV.
Do you love a good Coke?
Yeah. I suppose. Ali, last word to you real quick. These moves in these meme stocks, I think back to when we all cover here at Yahoo Finance, the original OG meme stock move. Now, this isn't quite the same, but it's extreme and it's something we haven't seen in a while.
Yeah, and I think that's why it's a big talking point on Wall Street right now, if we are at levels that are too frothy. But most strategists that I talk to say we're not there yet, and that's because the market is pretty healthy right now. We have, obviously, tech leading the way higher, trading at record highs, but we've also seen this breadth across other sectors as well. Financials, communication services, industrials, they are also at records, and that's a sign of a healthy bull market. Now, July is typically the quietest month for stocks on a seasonality basis. Usually in August and October, you see a bit more choppiness. And I think with the Fed policy still unknown, the tariff unknowns coming up August 1st, hopefully we get a little bit more clarity there. It's likely that we're going to see some volatility, but we just saw another record close for the S&P 500 and the NASDAQ. There's a lot of optimism in this market. Strategists are chasing their price targets. They're continuing to raise those year-end targets. I think we're going to see a few more raises before we get to the end of 2025. But of course, you have to wade through earnings season and all this volatility as well. So on the meme trade, I agree with Callie. I'm not totally surprised to see this happening right now. There's a lot of optimism, it seems, within stocks at this point, but that doesn't mean that the fundamental side isn't doing well, because it is, and that's really what's holding this market higher.
True that.
It seems like when we get these spurts of activities in the memes, they do tend to last a little while here. The longer it goes, what are some of the commentary you're seeing that stands out to you?
Yeah, Julie, I mean, one thing I think to sort of put the meme stock rally into perspective is this is kind of just the continuation of what one of the biggest trends in the market has been since the April bottom. It's been a lot of short covering, right? So we were speaking to strategists. I remember writing a story back in May. Going to sort of short covering was what brought the broader market back, right? A lot of people were quote unquote offsides, not necessarily bullish, perhaps positioned short. Then Trump sort of flips the tariff dial the other way. The market shoots higher. A lot of people got caught offsides in names like NVIDIA, right? Well, now you've seen that just move into smaller and smaller companies. So Bespoke had interesting research pointing out that the top 100 most shorted stocks in the Russell 1000 index have outperformed the overall Russell 1000 index by 33 percentage points over the last 3 months. That basically encapsulates the rally from the bottom. So you really, when we talk about meme stocks, we're talking about short covering, right? I think you could really just say this is a trickle-down effect of what has been a very popular trade and a very profitable trade for traders over the last 3 months at this point.
Meme stocks, we're talking GoPro and Krispy Kreme. When you watch these moves, Tom, is it fun? Is it concerning? What do you make of it?
Yeah, it's a bit of both. I think it's a sign of the environment we're in. We've had a record rally off the April lows. Most of the major indexes up 20, 30%. Stocks like Robinhood, Coinbase, Palantir, retail favorites are up 200, 300% in this short period. We're coming off 2 back-to-back 25% plus years in the S&P. And so, I mean, animal spirits are alive and well. I read a stat today, 70% of the options market volume is on the call side, and 27% of year-to-date volume in trading across the board is coming in stocks under $5. That's even higher than during the pandemic.
Because I asked that question, Tom, because I can understand some viewers will be watching this and they would be thinking to themselves, well, all of a sudden we're talking about, Josh and Tom, we're talking meme stocks, we're talking about SPACs again.
Yeah.
Just whether you see this sort of speculative activity, and is it a sign to you of froth in the market?
Yeah, typically we see this type of activity towards the latter end of a move. So again, not calling market top, but I mean, think about it. We're up 30% in the indices over 3 months. A lot of great news has been priced in, and I think earnings season is kind of bringing the market kind of back into focus on the fundamentals. And so I think it's just a sign of the times. People, you know, when you see your portfolio going up 25% in 3 months, you're not really interested in making 1 or 2% here. You're going for multi-baggers, as they like to say online. But I think it's also important to frame the conversation. People are not all in and all out. They are using a portion of their portfolio that is for fun and speculation and growth for these opportunities, and not necessarily taking the excessive risk that I think a lot of people think of.
And when you're watching these moves, Tom, do we have line of sight of who's in? I mean, is this retail traders? Is it the pros? Is it both?
Yeah, what I've been saying is that retail is starting the party and then forcing the institutions to dance. And what I mean by that is the institutions are kind of setting these stocks up for a meme type situation, heavily shorted, brand names that like have some fundamental value, but are not going to zero. And then we have sophisticated investors online, retail, using market mechanics against the institutions. So in the situation of Kohl's earlier this week, the stock moved from $11 to $20 in the pre-market. It doesn't take a whole lot of volume on the retail side to be able to move a stock like that. And if you're an institution that's short, or hedge against that stock, you got to make that move at the open. And so it's kind of a situation where retail is saying, hey, this situation doesn't make sense to us. There's a fundamental case to be made here, and we're going to move the market in our direction, and the institutions will have to adjust.
Let's say you're a GoPro or a Krispy Kreme.
Yeah.
You see these moves, right? What should be, you think, Tom, your reaction, your response?
Yeah.
How should you, if at all, try and take advantage of it?
I mean, every company with high short interest right now should be thinking about how do we convert conversation and attention into capital and long-term shareholder conviction. The difference between this being a short-term move where the stock just pops and moves lower is management's ability to go out there, raise capital, get their balance sheets in focus, and really tell a compelling story for shareholders to say, hey, this is not just a trade. We're really turning this business around. There's a fundamental reason to be involved here. And I think it's the investor relations departments, the executives that are using online platforms like StockTwits, like Twitter, like Reddit to get their messaging out there and tell a compelling story. Those are going to be the ones that stick around. Those who choose not to engage with retail are likely going to see their stock fall.
Let's have another name I want you to take on Opendoor.
Yeah.
We had EMJ's Eric Jackson on Yahoo Finance talking about the name. Take a listen to what he had to say.
Opendoor is not a meme stock. This is a real turnaround, legitimate turnaround story. It's an opportunity for anybody who missed Carvana, and I missed it at 350. I got in at $15 on Carvana, so I think I do know what to look for in these kinds of situations. And I think that this is the ground floor for a move to 82.
What do you make of Mr. Jackson's comment? He's talking to Opendoor and he's saying, listen, this is a real story. This is a fundamental story. What do you make of that?
Yeah, I think individual story aside, I think that's what's kind of attracting people to these situations. They see a company that's beaten down, highly bet against, and there's some glimpse of a fundamental case to be made where somebody can say, you know what, I kind of believe that. You know, maybe it shouldn't be trading at 82, but maybe it shouldn't be trading at $1. And there's a lot of room in between there. And so we're seeing people reassess situations that have otherwise been left for dead. And as retail gets into these names, institutions also have to adjust. And again, I think it's going to come down to the management team of Opendoor. What do they do with this situation? How do they create a compelling narrative? Because right now it's all about the stock price. It's all about what's happening with trading. But what's actually happening with the company? What are they going to do from a strategy perspective to get this back on the right footing?
More broadly, Tom,
Yeah.
I'm also just interested in the StockTwits community. How do they feel right now about this market? Where do they stand on this rally after the move we've seen after that April low?
I mean, it's quite amazing. Throughout the April period, we saw kind of institutions running for the hills on tariff concerns, but retail was in there buying the dip, and they've been quite aggressive throughout this entire rally. With that said, we're seeing some catch-up plays, come to fruition here. So instead of focusing on a Robinhood or a Coinbase that's up, hundreds of percentages already, they're looking at other opportunities. We're looking international. Japan just signed a trade deal. Chinese stocks are set to play catch up if they can get a deal. So people are looking for value. They're still bullish overall, but they're looking for opportunities where maybe the puck is going as opposed to where it's been.
When I last spoke to you, Tom, I remember, correct me if I'm wrong, but there was a lot of interest and enthusiasm, again, the StockTwits community, on themes like nuclear, themes like AI, crypto. Are those still front and center?
That's continuing. You're just seeing money rotate within those themes. So rather than play it directly through NVIDIA or directly through the same names, they're looking for other opportunities. So lithium stocks are a big one that I've seen pop off over the last couple of weeks. Solar stocks are catching a bid again. So people are seeing these broader themes and saying, okay, instead of buying the nuclear energy stock that's already up 400%, maybe I buy a solar stock because I know that there's going to be some energy component to this kind of broader theme. So
last question, Tom. What about crypto? Is that still a point of interest on the platform?
it's it's kind of spread as risk appetite has kind of widened here. Seeing a lot of meme coins, a lot of interest around Ethereum. There's a couple of treasury, Ethereum treasury companies out there. So definitely a hot area. I think the next phase for crypto and where people are looking on CryptoTwits is stable coins. We've got Circle, we've got Robinhood making a big move into staking and stable coins. So I think that's kind of the next leg of this crypto market rally.
The current meme stock mania can be tied back to a post from our next guest. That's Eric Jackson, EMJ Capital founder and president, writing in a post on X on July 14th that his firm was taking a long position in Opendoor, which was then trading under $1 a share. He said later in the thread that the stock could hit $82 a share based on the fundamentals. Since then, the stock is up nearly 200% as retail investors have piled in along with Jackson. He's joining us now to break down his bull case for Opendoor. Eric, it's been a long time since we've talked. It's great to be connected again.
How you doing, Julie? Good to see you.
I'm doing all right. Good to see you too. So first of all, I should ask, are you still in Opendoor? I mean, obviously depending on when you got in, you've done pretty well with this recent rally.
Yeah, no, I am. I'm ride or die to 82. I mean, not, obviously it's not like I got married to the stock. I mean, if I, suddenly saw that the management team was making terrible moves or whatever, I would change my mind. But I think the reason why I'm so excited about Opendoor is that I don't think it's a meme stock. The post predates all this meme stock mania. Carvana wasn't a meme stock, and Opendoor is not a meme stock. This is a real turnaround, legitimate turnaround story. It's an opportunity for anybody who missed Carvana, and I missed it at 350. I got in at $15 on Carvana, so I think I do know what to look for in these kinds of situations. And I think that this is the ground floor for a move to 82. So, something could happen to change my mind, but the plan is to stick with this and sit on my hands and let this thing compound.
So for people who maybe just have seen it as a meme stock or don't know what it is, this is a mobile platform for buying and selling real estate. Zillow was in that business and got out of it because they weren't making any money on it. And, at least if I look at the average Wall Street forecast, this thing is not expected to make money as far as the eye can see. So what are you seeing here? What's your bull case?
Well, nobody thought Carvana could make money. There was a time where nobody thought Uber could make money on a large national or international platform basis. So it's not unusual when you kind of e-commerceify or webify some kind of previously large fragmented industry that plagued with kind of legacy kind of ways of purchasing, whether it's the agents in the case of real estate or the dealers in the case of cars and Carvana. So iBuying is difficult. It's tough to make money. And I have been bullish on Opendoor before and have been wrong because I have been too early, which is the same as being wrong, because this thing has taken much longer since Powell raised interest rates and made it much, much more difficult to kind of get this thing to a steady state profitability. And so the reason why it got to 50 cents a few weeks ago is that Wall Street and most investors assume that this thing was just going to go, file for bankruptcy. It's not going to make it, just like what happened with Carvana in 2022 when it goes from $400 to $350. So I don't think it will. I think they are going to have earnings in a couple of weeks, and they're going to announce like their first EBITDA positive quarter in about 3 years. And they might not guide to kind of profits forevermore, but I think they're going to give some hints in that direction. And I think basically this is a business on the road to, within 6 months, steady state profitability. And the turn in the stock always comes before the proof that a company has reached steady state profitability. So I might be wrong. I've been wrong before about Opendoor, but I was wrong about Carvana. I didn't jump in at 350. I jumped in at $15, and that I still did great. But this time I'm sort of leading with my chin more and saying now's the time to buy. When it was under $1, it's still at $2. People say, "Oh, I missed the move, Julie. Oh, Eric, tell me about tweet me the next one." We're talking about a stock that could go to $82. You didn't miss the move.
I guess I would love a little more clarity on like how this turn happens, right? Yes, the Fed might cut rates, but how does that then get this company to profitability? Like what needs to happen?
Well, what's happened in the background for the last sort of three years is that Carrie Wheeler, who's the current CEO, took over for Eric Wu, who is sort of like co-founder, first generation CEO. She's been cutting. She's sort of like comes from a banking, private equity background. Cut. Get the fixed cost out of the business. Not dissimilar to what Carvana did, and get this business to the point where we can we even make money at iBuying at the current interest rate levels. They got thrown for a bit of a loop last year when Powell kind of paused on cuts, and so they had to cut more. Cut. So what happens is they can make money they will make money this quarter probably, at these rates, but their business is now set up with a little bit of easing, with a little bit of a decline in interest rates, which I think it's a sure thing. Maybe something happens and a Powell kind of tariff wars explode or something like that. But I think most of us think 99%. Interest rates are going to drop. Volumes increase. And the current platform that now exists at Opendoor can push a lot more business through it, make a lot more money than Wall Street currently expects. So that will be a huge tailwind for the business that no analyst on Wall Street is sort of counting on when they kind of look forward and make their estimates for this business in future years.
Eric, you said before it's not a meme stock. You believe in the fundamental story. Is it a bad thing that it has become a meme stock in the eyes of a lot of retail traders? In other words, like if everybody's excited about just sort of trading it or short squeezing it or what have you, is that sort of counter to what you're trying to achieve?
Well, I take offense to the meme stock characterization because I've yet to see a meme stock, and because I don't include Opendoor amongst the group, that is a real business. I think these meme stocks are dumb businesses. I would never want to own a donut business. I would never want to own GoPro. I don't think we're on the cusp of some GoPro resurgence, and everyone's going to be walking around with GoPros on their heads, the way that we thought when they initially IPO'd. So why people get caught up in that, that's not me. I don't even think GameStop was a real business. Although you could, obviously initially in the early days, it was a value play and a high short interest and all that kind of stuff. Yeah, that's sort of the most believable. But today, why would I, there's other Bitcoin treasury businesses. So why do I want to own a dying retail chain? So Opendoor, I think is a real business. Is it bad that you get the flippers? Well, like a couple of days ago, we sort of like almost broke the markets when Opendoor surged like 120% and almost touched $5, when a lot of shorts would have had to cover, by the way. And then suddenly the NASDAQ halted it. And then there was sort of like mass confusion. On that day, 1.9 billion shares of Opendoor traded. 723 million shares exist. That's the total shares outstanding for Opendoor. So the next day, 1 billion shares traded. Yesterday, about 500 million shares traded. So obviously there are flippers here. I think, I don't understand it because I still think we're in the early innings. I mean, everybody's got to make their own investment decisions for themselves. But I mean, I did put out a tweet this morning that said, wouldn't it be interesting if all retail shareholders, all institutional shareholders, if they buy this argument that this is the next Carvana and this thing is going to 82 and we're on the ground floor. Imagine if they just put all their energy into buying the stock and holding it. If they did and didn't flip out every 2 hours or whatever they're doing, this thing would have a Cisco.com era type of an explosion. It would be a supernova event. GameStop would pale in comparison to what's possible if we applied the Wall Street Bets crowd to a real serious turnaround business. So maybe people will think about that. I mean, I'm not counting on it, but it's a real.
That would be great for you, though. If that's what happened, Eric. To be clear, it would benefit you. It would benefit you as well. Just real quick, before we let you go. Anything else you've got your eye on now that's going to be sort of your next bet here?
Well, I mean, two stocks I mentioned before, Opendoor, which gave me kind of the idea, that, I think there's an audience for the next Carvana with Opendoor, but two other next Carvanas, which I own, Iron, I-R-E-N, and Cipher, C-I-F-R. They're both Bitcoin miners. They make a lot of money from mining Bitcoin right now, but they've moved aggressively years ago into the AI HPC business, similar to what Core Scientific was doing, but these two are much bigger. They have much more in the pipeline. They each have 3 gigawatts of AI data centers, which they have built or are building, which are going to get energized in the next 12 to 18 months. And I think Brian Sozzi this morning was like tweeting out like the massive shortage for these AI data centers for power, for getting connected to the grid. These two stocks have those connections. They have the gigawatts. And I think there's going to be a massive re-rating in them. They could 100x each themselves.